Hi everyone, if you're new, well, I'm glad you found my channel. I personally am an investor and you can check out my portfolio in previous videos. See, the problem I have is that people spend far more time researching their next phone or TV than their next investment. Are you someone who's a little concerned that something just doesn't feel right about all the hype around Bitcoin or Tesla? Well, you're not alone. My strategy is to look at an investment based on its financials, just like we would if we wanted to buy an entire company and run it ourselves. And today I'm going to do a quick high-level valuation of a company called Corsair Gaming to see whether it is worth spending some serious time researching the company. Now, I'm not doing a full analysis here. I don't have the time to seriously analyze the thousands of companies out there, so I'm trying to filter out as many of them as I can using this method. Even if the company passes or fails this quick valuation, it doesn't make it a good or a bad investment. It's just a way to motivate me whether I want to go onwards and do further research and study the company in serious detail. So please don't invest in a company unless you have done your due diligence. So just follow along to learn how to do this yourself, and we will have a target buy price by the end of the video. Look, it's part art and part science anyway, and the more practice we do, the better we're going to get. So let's go do it. Now, Corsair Gaming is available on the Nasdaq Stock Exchange under the ticker CRSR. I'm going to go through my 9-point checklist with you now, and then I'm going to give you my opinion at the end, whether we should dive deeper and do more research. First point is we need to talk about what is Corsair Gaming. Now, look, this is obviously a company that creates products in the gaming industry. Now, I love the online gaming industry. I think there are a lot of tailwinds. I've looked at Activision Blizzard, EA, I've looked at Nintendo before. I've looked at Logitech before as well. I really like the world push into online gaming. I think the industry has a lot of potential in the future. So look, it's in a good industry. That's a good start. Now, the products that they make, they're not making games, they're not making software, they're actually making physical accessories. So we're talking mice, keyboards, computers, things like that. Now, headphones as well. So their competition is probably going to be the issue here, because I've looked at Logitech before. I've looked a little bit at Razer and Turtle Beach before. There are just so many competitors in this space in the accessories to online gaming. It's a place that a lot of people want to play. Standing out from the crowd in this space, I don't know whether they're going to have a clear competitive advantage. Maybe the financials will give us a bit of a hint into that. So let's go take a look. Now, the first thing we want to see is revenue growth. Obviously, revenue is generated from the cash coming in from selling their products. Now, when I look at the revenue growth for the last few years, we've got only from 2018, we can go as far back as we can go. Now, it went up 10% from 2018 to 2019, then a big jump from $1 billion to $1.7 billion. And then it looks like the trailing 12 months, well, the 6 months or so roughly so far, they're going to push, probably going to get close to 2 billion. So it has been growing, so I'm happy to give that a tick. Now we look at the gross margins, and gross margins is, I think, really important to see if the company does have a competitive advantage. If these gross margins are getting stronger, it means they can charge higher prices and they're still getting the sales and the support from their customers. So gross margins percentage, it was 20%. It's now 28%. So it is growing. The problem is it's actually really low. I like to see companies above 40% in their gross margins. That gives them some room to have a few things go wrong in their business and to try a few things and reinvest money back into the growth of their business. At such low gross margins as these numbers are, at least it's growing, but the numbers are low comparing it to other companies. So I don't love that. Return on invested capital is the percentage that tells us how well the management are taking the money that they get, their profitability and their free cash flow, and investing it back into the business to grow it. So to find return on invested capital, we look at the key ratios. This is the return on invested capital here. Now, 2018, 2019 was really poor. 2020 was strong. Trailing 12 months is strong as well. We have to point out that probably some of this is going to be pandemic related. We're talking mice, keyboards, computers, things like that. People were sitting at home, obviously, and buying gaming accessories. There's obviously going to be a clear demand while people are sitting around at home for this. So I'm happy with return on invested capital at the moment, but the problem is, this is probably pandemic related. The next thing we want to look at is the debt levels. Debt's very important because, well, a company that doesn't have any debt, they're going to really struggle to go bankrupt. It's really the only way a company can get into trouble is if they're over leveraged. Now, some debt can be good because it can fuel their growth. We just have to wait. We have to make sure that it's manageable. So to do that, we look at the current ratio. We want that over a 1.5. So to find this, we go into the financial health of the company and we have a look at here it is down here, the current ratio. Now it's been pretty solid really. We wanted it above a 1.5, being a 1.43 is fine. That's pretty much the same thing. It's very close. I'm actually happy with that. That's not a problem. Free cash flow. Free cash flow, I think, is probably the most important metric in what we're going to use to value the company on. Now, this is essentially the cash coming in from running the business minus all the things needed to keep the business going, like maintenance of stuff, of their factories or whatever the maintenance they need for their company, and investing into new projects. Whatever's left over, we call that free cash flow. Now, free cash flow growth has been, well, again, I'm a bit concerned this is pandemic related. 2018 was actually a negative number, probably reinvesting it back into the company. 28 million and a big jump up to 160 and now potentially 180 million dollars. So look, it's definitely growing, but I'm still not sure what I'm going to think of this yet. Now turning to the brokerage accounts that I use. So I use Interactive Brokers and Saxo Bank to invest in these companies like Corsair Gaming and other things like this. Now, the cool thing about Interactive Brokers and Saxo Bank is they have access to the international markets. If you're with something like Robinhood or anything like that, they're not reputable, they're very new companies, and they don't give you access to international markets. So Interactive Brokers and Saxo Bank are clearly better, from my opinion. Now, I do have links in the description. They are affiliate links. For the Interactive Brokers link, if you do sign up, you will get $200 worth of free Interactive Brokers stock. It's just a gift when you do deposit and open up that account. And the link is, like I said, in the description. Okay, next thing we're gonna look at is shares outstanding. Now, this is really important as well because if this number is getting bigger, it means we're getting diluted and that's a bad thing. We want our ownership percentage actually growing, which means the shares outstanding has to be getting lower. So let's have a look at the shares outstanding. Here it is here. It was 92 million back in 2018. It's still 92 million. I'm actually fine with that as long as it's not growing rapidly, which it isn't. We're good with that. Now we're looking at insider ownership. Now we obviously want the people who are running the company, we want them to be invested heavily in the outcome of the share price, just like we would be as the shareholders. So what I'm looking for is this guy here, Andrew Paul, who is the founder. He's been the founder for, well, since the start, 27 years ago. He gets $2.8 million in compensation, but he has $77 million in shares. That's the percentage of his ownership in the company. So that's perfect. It means that if the share price goes up, it affects his net worth. But if the share price goes down, well, it definitely affects his net worth, and his compensation is not even close to the same as his ownership in the company. So great, we can give that a tick. Super investors. Now, I want to see, this is one of my criteria that I like to use because I want to see someone else who's smarter than me, better than me, who's been doing this for multiple decades, who's gone through different cycles before. I want to see someone like that invested in this company. So unfortunately for Corsair Gaming, they don't have any super investors that I've found. So unfortunately, we have to give that a cross here. Now, the last point on my checklist that I'm going to go through is the price. Price is obviously the most important thing because, well, it makes a really good investment great, or it can make a really good company not a good investment at all. It's all about the price we pay. Just like I use this example here is you wouldn't buy a new Ferrari for $20 million. It's a good car, but that's a bad price. The value of the car is probably only $250,000. So the price you pay is critical. Anything can be a good investment, anything can be a bad investment based on the price. So let's go do that. Now, I'm going to use my intrinsic value calculator, and you can get a copy of this. It's free, it's in the description. So I want to look at growth rates. Now, if I look at the revenue, the top line revenue growth here, it was growing at say 10% for this year. It looks like it's going to grow maybe 10, 15% from 2020 to 2021. But there's that big jump between 2019, 2020. That's obviously pandemic related. Now, if I also go have a look at what the analysts think, look, I don't like trusting analysts at all. I prefer to do this myself, but they also think the next 5 years is going to be around about that 10% mark. So I'm pretty happy giving it a 10% mark at the moment. The 5 years after that, now companies generally slow down. We don't know, the further out we go, the further out we're trying to predict, the harder it is to get this accurate. So we want to be conservative here. So we're going to say competition is stronger in the future. So let's say it drops down a little bit, their growth rate. That's only a small drop anyway. Now the discount rate, I'm going to put in 30%. Now a lot of people are going to use 10% or 15%. I use 30% because this is how I incorporate my margin of safety. If I can buy it at a price where I can get potentially 30% return on my money, that's fantastic, because even if I don't get the 30%, there's a high probability that I'm probably going to get close to that, maybe in the 20% range. So that's what I'm looking for, and that's how I incorporate my margin of safety. So the multiple I could sell it for after 10 years, for a company growing at these speeds, is probably going to get a pretty mid-range multiple. So we're going to give it a 15. Now, the operating cash minus maintenance capex, this is essentially free cash flow. This is just an advanced way to find the free cash flow number, but we're going to just pull the free cash flow number directly from here. Now, look, the trailing 12 months is going to be 181. I think this is probably going to be a bit on the high side, just because the pandemic is probably, I can't imagine this big growth happening anywhere near it again. Maybe it's flat, maybe it's not even, maybe it's a little bit lower. Let's use just the 2020 number for now. Let's say they're just going to not grow for the next 12 months because they got a lot of their sales in 2020 and they're just going to maintain the business. So we're going to call that $160 million. Okay, shares outstanding, well, we said that was 92 million. So let's put that in as well. Then we got to get the total cash and total debt. So I go over to Yahoo Finance, I go into statistics. Total cash is 121 million. And the total debt, it actually says it right here for us, 324 million. So 324. Okay, now the price that I would like to buy it at is around about $8.80. Well, look, let's call that 10 bucks. When it gets to $10, it's getting very interesting here based on these growth rates. Now let's go have a look at the actual current price. Wow, okay, so it's about $30. I would say this is way overvalued for me personally. Now, what we could do is be a little bit more aggressive. Let's say we think, okay, the industry tailwinds, let's say they do have some sort of strong competitive advantage. I don't know what that competitive advantage is. I'd have to do some research, but let's be really aggressive and say it's going to grow at 15%. That's way above what the analysts think, remember. Let's say then only goes down to 12% after that. Again, still above what the analysts think for the next 5 years. Let's put a let's make our return on investment goal just 22%. So our margin of safety is really small, a lot smaller now as well. And we get a buy price of about $20. And at a share price of $30, I can't get on board this at all. Like, even in a very aggressive situation where I'm not getting the return that I want and I'm being optimistic on the growth rates, I'm still not even close. This is a clear pass for me on the price, just the price alone. So my overall opinion, it's a relatively solid business based on most of these financials, which is not too bad. I also really like the industry. I really do. The gaming industry is just one of my favorites. But because they're in the physical electronics space, even if it is in the gaming space, there's just lots of people wanting to play in this space, and gaming is trendy. It's a very fast moving industry. You've got to keep up with the new technology that's always coming out. I don't know how good the competition is in comparison to Corsair with Logitech, Razer, Turtle Beach. There's plenty of these in the world. Their gross margins are challenging for them because they don't have big room to reinvest into the new technology with those slim gross margins. There's no super investors. And look, even with those good growth rates, the price isn't even close. So I'm going to give this a hard pass. Now, I might be completely wrong here. I've done a very high level valuation. I haven't dug into the company hardly at all. So look, if you've invested in this company or you're really bullish on this company, look, that's for you to decide in your research. But I'm not going to spend the time digging into this company because it just hasn't gone anywhere near what I would be looking for just from that high level approach. And this is how I would filter out a company. It doesn't make it a bad investment. It could be one of the best investments of all time, but I'm going to give this a pass for me personally. If you love it, Just put in the work to make sure that you really understand the business, and that's how you're going to separate yourself from people like me anyway. I hope you've enjoyed this valuation and maybe you've learnt something along the way here as well. If you haven't yet subscribed to my channel, please do so you don't miss out on future videos like this. Hit the like button before you leave, and I will see you soon.